Okay, let's unpack this. For anyone on the path to financial independence, the goal is often high, stable, passive income.
Right.
But the financial media is usually selling fantasy. What does a real, living, breathing investment structure look like when it's specifically designed not just to fund retirement, but to support an actual nomadic, global lifestyle? Today, we are cracking open a unique and fascinating investment structure we're calling the Blueprint to Escape case study.
Exactly. Our mission today is to go beyond the hype and really analyze their mid-December 2025 portfolio holdings.
Okay.
This case study is, it's a live snapshot of a highly optimized income portfolio. It's custom tailored to generate sustainable, predictable monthly income for someone who prioritizes flexibility and resilience.
And the number that grabs everyone's attention right out of the gate is the yield.
Of course.
As of mid-December 2025, this overall income portfolio is delivering an approximate 13.5% yield. I mean, that is a massive income stream.
That 13.5% is certainly an impressive figure, especially in a market where, basic bond yields are still relatively tame. But the true story isn't the number itself.
It's the how.
It's the how. It's the stability they've built around it.
So here's where it gets really interesting. How do you achieve that kind of high yield 13.5% while at the same time holding fast to the principle of capital preservation, building in resilience against market downturns, and, maintaining the balance needed for a low-stress nomadic life?
It's a balancing act.
We need to dive deep into the philosophy first because the strategy dictates the tickers, right? Not the other way around.
The philosophy here is the bedrock. Their primary mandate is pretty straightforward. Build sustainable passive income with growth potential.
Okay.
The core objective is generating consistent monthly cash flow with minimal risk to the initial capital. They operate under a strict, non-negotiable rule.
A hard line.
A very hard line. Capital preservation first. Do not risk loss of principal.
That immediately introduces tension. If your focus is preservation, how do you manage to pull in 13.5%? I mean, what strategic choices did they make to reconcile those seemingly opposite goals?
Well, they focus relentlessly on income generation. We see a heavy leaning into monthly income-generating investments, specifically covered call ETFs.
Right.
And they're targeting that sweet spot in the 8 to 18% yield range. They also leverage instruments like business development companies or BDCs.
Which are? Exactly, for those who don't know.
BDCs are firms that lend to or invest in small and mid-sized companies. They offer high distributions because they're legally required to pass on most of their taxable income to shareholders.
So they're using specialized income tools to get that yield without just chasing, say, single stock dividends, which can be much more volatile.
Precisely. And their compounding discipline seems absolute.
How so?
It is. They reinvest all income immediately, and they continuously leverage dollar-cost averaging when deploying new capital. This smooths out market entry points, and it maximizes compounding over time.
And that reduces the psychological pressure of trying to guess the market bottom.
Totally. And their market approach is purely rational, almost stoic.
So no emotional decisions.
Yeah. None. Avoid market timing entirely. Invest with conviction based on the plan, not emotion, and stay adaptive by periodically rebalancing when the allocation rules get skewed.
That stoicism is really reflected in their risk tolerance, and this feels key to understanding the blueprint.
It is key. They explicitly state they are willing to accept lower gains during those blistering bull markets.
The times when everyone else is bragging about 30% returns.
Exactly. They'll take lower gains then in exchange for greater downside protection when the bears inevitably show up. This is the definition of prioritizing risk-adjusted returns.
They prefer the smooth ride.
They do. And that focus on consistency brings us to the most critical warning for anyone chasing high yield, which this case study addresses head-on.
Which is?
The crucial distinction between focusing on yield only and understanding total return.
Ah, yes. This is where so many high-yield portfolios just completely crash.
They do. Total return is what truly matters because it includes both the increase in the price or capital value of your portfolio, plus the income distributions you receive. You simply cannot look at yield in isolation.
Right. If an ETF is yielding 20%, that sounds amazing. But if the fund's price drops by 15% that year, your total return is only 5%.
Exactly. And the case study explicitly warns about net asset value, or NAV, erosion.
Okay, break that down for us.
Think of your portfolio as a farm. The principal is your seed corn. If a fund's yield is excessively high, and for this aggressive income portfolio, they flag anything over 18% as potentially risky. It's highly possible that the fund is simply paying out capital or eating the seed corn to maintain that distribution rate.
So the fund isn't generating enough true income, but it's paying the dividend by effectively giving you back your own savings.
Precisely. This leads to NAV erosion.
Yeah.
Your capital is being consumed to pay the dividend, meaning you are slowly losing principal over time, which completely violates their core rule.
The capital preservation rule,
Capital preservation rule.
which explains the time-tested maxim. There's no such thing as a free lunch in finance. If the yield looks too good to be true, it's probably eroding your principal.
And their structural rules reflect this prudence. They focus on the structure of the portfolio, avoiding worsification.
Ah, I love that term.
It's a fantastic term they use for over-diversification. They currently hold about 25 to 30 positions, but they believe the sweet spot for their income portfolio is actually tighter, aiming for 20 to 25.
And they also maintain a strict allocation rule, right?
They do. No single stock or ETF is allowed to exceed 15% of the total portfolio weight.
That's a crucial guardrail against concentration risk.
It forces diversification, even among their highest conviction holdings.
Okay, so now that we understand the philosophy, stability, high income, capital preservation, let's look at the actual breakdown for mid-December 2025. This portfolio is unique because it's structured around two main currencies.
Right. Canadian dollars and US dollars, which reflects their identity as a nomadic expat with a Canadian base.
And that currency split isn't just random.
No, not at all. It's highly optimized for their tax situation. About 80% of the total portfolio weight is in Canadian holdings, primarily housed in two key Canadian tax-advantaged vehicles, the TFSA and cash accounts.
For our listeners who aren't familiar with the Canadian system, quickly tell us why the TFSA matters so much here.
The tax-free savings account, or TFSA, is monumental. Any growth or income generated within that account is permanently tax-free in Canada.
Wow.
So by placing their high-yield Canadian assets there, they ensure that significant monthly income stream hits their pocket without immediately triggering a tax bill. It's all about maximizing the velocity of their income.
Okay, so on the Canadian side, which is the bulk of the money, what's the biggest position?
The top concentration is HDIV, sitting right at their 15% maximum weight, and it delivers a solid 10% yield. This acts as the anchor, a core, reliable monthly income holding.
But wait, if their hard rule is capital preservation and minimizing risk, how do they justify holding positions like HHIS, which is 10% weight, with a massive 25% yield, and HBTE, which is 9% weight, yielding an even higher 29%? Doesn't that directly contradict the whole NAV erosion warning?
That is the informed skepticism we need. It looks like a contradiction, but it's a calculated risk offset. They use these ultra-high-yield covered call strategies, which often target specialized volatile sectors like tech, infrastructure, and blockchain, to aggressively juice the overall 13.5% yield.
So they're balancing it out.
Exactly. They keep the bulk of their capital, like that 15% in HDIV, in lower-risk instruments to balance the volatility.
So it's like a high-octane engine sitting in a very heavy, stable chassis.
Precisely. And they also have growth ballast. We see elements like XQQ, which tracks the NASDAQ Q100 at 0% yield, but holding 3% weight.
Purely for growth.
Purely for long-term capital appreciation potential. It provides that growth element required by their core philosophy alongside the income drivers like HMAX, Bank, and Utes.
Let's move over to the USD holdings. This accounts for the remaining 20% of the total weight. What's the strategy here?
So these USD assets are held in RRSP accounts, the Registered Retirement Savings Plan.
Which is tax-deferred.
It's tax-deferred. The primary benefit here for a Canadian resident holding U.S. assets is twofold: dual goals of income and long-term growth, and crucially, they can take advantage of the tax treaty between the U.S. and Canada.
And that allows?
That generally allows U.S. dividends held inside an RRSP to avoid U.S. withholding tax. Again, it's all about tax optimization.
Okay, and the USD side is also packed with high-yield tickers. QQQI at 14% yield, BTCI at 27% yield, and GOW at an incredible 34% yield.
Right.
But those are all held at much lower, more equal weightings, around 2% of the total portfolio each.
And that's the management of the contradiction in action. These are high-risk, high-reward plays, so they are kept small. We also see pure growth stocks here, like GOGL, which is Alphabet, and WGMI, both at 0% yield.
Balancing out the high-yield covered calls on the U.S. side.
That's it.
What's fascinating here is that the deliberate use of the TFSA, which is tax-free, for the large Canadian income chunk, and the RRP, tax-deferred, for the USD assets. It just confirms this deep commitment to optimizing every aspect of their nomadic life structure.
It's crucial for international investors. It's the highest level of tax efficiency. They didn't just pick good stocks, they picked the best location for every stock, which is arguably more important for someone managing their finances internationally.
So we have a portfolio that's stable, resilient, highly optimized for taxes, and currently yielding 13.5%. But even the Blueprint to Escape team recognizes that a static portfolio is a dead portfolio.
Mm-hmm.
So what does this all mean for January 2026? They have 5 immediate actions planned.
And this is the sign of maturity. Constant evaluation and tactical adjustments are the hallmarks of disciplined investing. Their first action is a direct response to volatility.
They're reducing risk.
They're reducing risk. They're drastically cutting the weight of HBTE from 9% down to no more than 5%.
And that position had the highest yield at 29%. Why cut that one?
It did, and the reason for the cut is highly instructive for anyone managing risk. While they are convinced about the underlying sectors, AI, fintech, blockchain, the volatility is simply too high for their stress-free life mandate. Some underlying stocks, like iron, have betas above 4.
Okay, for listeners who don't spend their time looking at financial models, what does a beta above 4 actually mean in practical terms?
Sure, think of beta as a measure of volatility compared to the overall market. A beta of 1 means the asset moves exactly with the market.
Right.
A beta of 4 means that stock has historically been 4 times more volatile than the market index. So if the broader market drops 1% on a bad day, a beta 4 stock could plummet 4%.
Ouch.
That extreme swing leads to the mild total return loss they experienced since purchase, despite that huge 29% distribution.
So they're essentially admitting that the high yield on HBTE just wasn't worth the price volatility.
Or the stress it introduced. They're choosing stability over hyper-growth potential from a single volatile instrument.
Okay, so action 2 focuses on the bottom-up increase in growth.
Right. They want to tighten the structure and ensure no holding is less than 2% of the total portfolio, consolidating those tiny positions. Specifically, they plan to continue building their Alphabet, or GOGL, holding.
Why that one?
They believe it's one of the most undervalued MAGI 7 stocks and has a strong economic moat, meaning a sustainable competitive advantage. This shows they are not ignoring growth entirely, they're simply choosing stable growth.
Makes sense. Action 3 is a simple review of their USD strategy.
Yeah, they're revisiting high-quality covered call income ETFs, such as JPQ and GPIX on the USD side within the RRSP. Always shop around for the best management teams and option strategies.
And Action 4 addresses core consolidation on the Canadian side.
Right, streamlining the Canadian holdings. They want to slightly tweak and rebalance their key Canadian ETFs, including HYLD, HSS, AGHL, HTA Bank, HMAX, EBNK, and INCM. So they all sit consistently between 4% and 7% weight.
And that might mean removing a couple of positions.
Potentially, yeah. To reach that optimal 2025 sweet spot while keeping HDIV anchored at that 15%.
So that brings the portfolio structure into tighter alignment, reducing the potential for that worsification they warned about earlier.
Exactly.
Finally, Action 5 is a proactive defensive shift.
They are looking for leeway to squeeze more defensive or neutral sectors into the mix, specifically adding exposure to healthcare REITs, which are real estate investment trusts, and to our private credit ETFs.
And that introduces another layer of non-correlated resilience.
Which is absolutely essential when you're designing a passive income plan that needs to survive multiple market cycles.
So if we connect this entire blueprint to escape case study to the bigger picture, the most valuable lesson isn't what tickers they bought, but how they structured their decisions.
Absolutely. The main lesson is the importance of alignment. The portfolio must match your personal affinity. Do you genuinely understand the sectors you are invested in, whether that's tech, Canadian banks, healthcare, or commodities?
And it has to match your goals.
And it must match your age and retirement goal. This blueprint, aimed at early retirement and passive income, correctly favors stable covered call ETFs over pure accumulation plays.
That's a fantastic synthesis. The portfolio truly is an extension of your life plan.
Exactly. And your investment choice, the currency, the broker you use, the account type, it must align with your unique tax situation.
We saw that with the TFSA and RRSP.
We did. For Canadian residents, maximizing the use of the RRSP and TFSA is paramount. For our U.S. residents, that means maximizing the Roth IRA or the 401k. The principle is universal. Use your local tax advantages aggressively.
This Blueprint to Escape case study provides a fantastic roadmap for generating reliable income on the, let's face it, challenging path to financial independence, passive income, early retirement, and achieving that nomadic life design.
It really does. And we encourage you to post comments or questions below about your favorite income strategy or, any questions you have about this portfolio. And please do subscribe for more content about financial independence, passive income, early retirement, and nomadic life design.
Also, the research team has posted a link to their full portfolio as per mid-December 2025 in the description section for you to review. We highly recommend you check it out to see the full list of tickers and weightings and see how they are structured.
And please remember this vital closing disclaimer. This analysis is for educational and entertainment purposes only. This is not financial advice. Always conduct your own thorough research and speak with a licensed professional before making any investment decisions.
Now, here is a final provocative thought for you to chew on that builds on Action 5. The Blueprint team is cutting volatility with HBTE and adding defensive stability. Given the need to maintain that impressive 13.5% yield, what percentage of your own income portfolio could you comfortably put into defensive sectors like healthcare or private credit without compromising your overall income target? Something to mull over until our next deep dive.